First home buyers essentials, all you need to know to buy your first home sooner. Welcome to First Home Buyers Essentials. This is Module 5. Of course, we do have our disclaimers. General advice only. The information contained in this course is general in nature and doesn't take into account your personal situation. You should consider whether the information is appropriate to your needs and where appropriate, seek advice from a qualified professional. Secondly, taxation, financial, legal and other matters referred to are of a general nature only and are based on Home Finance Hub's interpretations of laws existing at the time and should not be relied upon in place of appropriate professional advice. Those laws may change from time to time. And finally, I'm an authorised credit representative of Blessed Proprietary Limited and a mortgage advisor accredited with the Mortgage Finance Association of Australia. Module 5 is insurance requirements. Just a quick overview of the things that you need to know about insurance when you're buying your first home. So what we'll cover in this module, there's 3 stages to this module today. Firstly, we're going to look at lender's mortgage insurance. Secondly, we're going to look at household insurance. And thirdly, we're going to look at family protection, and that's protecting your family through using insurance as well. So lender's mortgage insurance is a frustrating expense because it penalises people trying to get a start or a restart, but it serves a purpose in protecting lenders from default in higher risk positions. It's higher risk because, it's higher risk for them because there's less margin for error in the case of default. So lender's mortgage insurance protects the lender for any shortfall in the sale of a property should you default. So obviously the higher the loan to valuation ratio, so the higher a higher amount of skin they have in the game, the higher risk there is. So, it does protect the lenders. It applies where the LVR or loan to valuation ratio is greater than 80%, so that your loan is more than 80% of the value of the property, except in the case of a family pledge. That's different, and we'll discuss that in the finance modules. Thirdly, the premium rates rise as the LVR percentage does. So, as you get closer towards 95%, so does the premium increase, so that you could be paying 3 or 4% additional on top as an insurance premium. The insurance premiums may vary from lender to lender, so different lenders have arrangements with the mortgage insurers. There's a couple of key mortgage insurers in the market, Genworth and QBE, and it depends on the relationship of the particular lender with those insurers what the rates are that they can offer their customers. So some lenders have lower rates than others. So it's also a one-off cost and it's not portable. And what I mean by that is it's a one-off fee that can be capitalised onto your loan balance. But if you were to refinance your loan, that insurance doesn't go from one lender to another. So if you had a mortgage over a first home that you'd bought at 90% loan to valuation ratio, meaning that you've put in 10%, the mortgage insurance that you've paid on that, were you to transfer to another lender, you would pay that mortgage insurance again. So that's something to be mindful of. It's not portable at this point in time from one lender to another because it covers the risk of the specific lender under their circumstances and their agreements with the mortgage insurers. However, there is a sweet spot in mortgage insurance, and that is around that 88% mark. So if you're below 88%, you're getting good bang for your buck, and the impost on you as a fee for mortgage insurance is not as significant as when it gets over 88%. So there's definitely a cutoff point at 88%. It gets higher again at 90%, and then just grades upwards from there. But if you can keep it to 88% or less, then you're actually getting really good leverage at those points. So there is that sweet spot there at 88%. There's also the federal government scheme, which we have talked about earlier in first home buyer benefits. And the federal government scheme is actually knocking out that lender's mortgage insurance requirement for 10,000 Australians per annum. And basically they're insuring the amount between 80 and 95% so that you can come in with a 5% deposit and not have to pay the mortgage insurance. So the government's going to basically absorb that cost, and really that can save you thousands or even tens of thousands of dollars from what your cost would be were that scheme not in place. So again, once we have all of the details of that scheme, we'll be providing them to our subscribers so that you can be better informed as that goes onwards. So that's lender's mortgage insurance. Next, we're going to move on to household insurance. So household insurance, we have home insurance, which protects the structure of your home against fire, flood, damage, etc. It's required by lenders because they need to protect the asset that they're lending against, but it also protects you because it's probably the biggest purchase that you've ever made up to this point, buying your first home. So it protects the lender and it protects you. Insurance is all about protection one way or another. And the next part of household insurance, and there's only two aspects to this. There's the home insurance, but there's also contents insurance, and it's something that we often underestimate. We underestimate all of the things that we have and what they're actually worth. So the bonus download for this module will help you out with contents insurance, and it's actually a detailed checklist. I remember the first time that we did household insurance, we did contents insurance when we were far younger. We actually walked through our house room by room and looked at all of the things that we had, and we had to put a value on them. So including your clothes. So if you think about the replacement value of the clothes that you've got, that's perhaps what you should be insuring them for, rather than what they're worth were you to sell them. If you've got a television and it gets stolen or it gets broken, well, you need a new television. You don't need an old television. So the value of your home contents can be quite deceptive, actually. So anyway, go through that spreadsheet, which is attached as the bonus download for this module, and that should be able to step you through that process. We've also attached a summary from one of Australia's insurers, which has some ideas around what's kind of an average from their perspective, and they're a big insurer, so they kind of know their stuff. It's a useful benchmark and measuring tool for doing that. So I want to talk a bit about family protection insurance, and it's key for all of us. And there's two parts to this conversation. There's the what if I die insurance, and there's the what if I don't die insurance. If you're single, the what if I die insurance is maybe not as important to you, but if not, you might want to consider protecting your family. We don't like to think about it, but it's a real thing. And how does the home loan get paid if you're gone? So similarly, if you have an injury or a major illness or health event that disables you or stops you from working, you need to consider the if I don't die insurance. How would I keep my home if I was unable to work? A question that you should consider, and it's part of a mortgage broker's duty of care to ensure that you considered how you will be protected. So as part of that, there's TPD, which is total and permanent disability, and then there's income protection insurance. So, income protection will insure you if you're injured and unable to work, perhaps where you're not covered by workers' compensation insurance. Total and permanent disability would occur in the case of a major event where you're unable to work. And that's total or permanent disablement, and those kind of insurances, the if I don't die insurances, are probably, if not more important, just as important as life insurance in ensuring your family and your home going forward. So it's an important consideration as part of the process. So here's our really quick summary of learnings for this module. We've looked at lender's mortgage insurance. Lender's mortgage insurance is a fee for lower deposits. So if you've got less than a 20% deposit, basically the bank requires you to pay an insurance premium that protects them in the case of default and the property not achieving enough to pay out the loan. It's not portable, so you can't take it from one lender to another if you're chasing a different rate. You need to be really mindful of that. So it's important to get that right at the outset. And thirdly, there is a sweet spot at 88%. So anywhere between 80 and 88% loan to valuation ratio, you're getting really good leverage and not at a high cost in terms of that risk premium that you'd pay. However, above that, you are the cost is ramping up quite significantly as it heads up towards 95%. It's a cost, but it does allow you to borrow on a lower deposit. There's just a price to pay for that up front. There is the federal government scheme which is coming into place from the 1st of January 2020, and that is going to remove that cost for 10,000 Australians between 80 and 95%. So you can come in with a 5% deposit and not have to pay the mortgage insurance, because basically the federal government's going to cover that for you. And the great thing about that is it can save you thousands, maybe even tens of thousands of dollars in some cases in expenses. Now, we then looked at household insurance, we looked at home insurance and contents insurance. Don't forget to have a look at the bonus spreadsheet that we've attached as part of the module, where you'll be able to actually detail all of your possessions and contents and put some value to them, so you can accurately fill out your contents insurance requirements. And it's really all about protecting your assets. And continuing that summary of learnings, we just looked at family protection insurance. We talked about the If I Die insurance, which is life insurance, and you should consider that to protect yourself and protect your family. And there's the If I Don't Die insurance, which again is all about protecting yourself and protecting your family and being able to make your loan repayments if you're disabled or you're injured and unable to work. It's, again, as I say, it's insurance that protects your family, and it's something that brokers have to have conversations with customers about, because we have this duty of care and to act in your best interest, but also to make sure that you've considered these risks and have addressed them in some way. I would certainly have considered those insurances. So congratulations, you are yet another step closer to owning your own home sooner with First Home Buyers Essentials. This has been Module 5,